Welcome back. You're watching The Firm. Mutual fund investments are subject to market risks. Read all scheme-related documents carefully. While most investors pay heed to that warning only when investing in equity mutual funds, debt funds are often perceived to be safe. So last year, when JP Morgan's debt schemes fell into trouble, it served as a wake-up call for investors, the mutual fund industry and the regulator. Last week, SEBI announced new prudential guidelines for mutual funds. Do they fix all the problems? Not quite, says Sajeet Manghat. On August 7, 2015, credit rating agency CARE suspended its rating of Amtech Auto. The auto component manufacturer had till then enjoyed a AA- rating on 7,644 crore rupees of bank loans and 1,880 crores of non-convertible debentures. CARE said it suspended the rating because the company had not provided adequate information. At the time, JP Morgan AMC was the only mutual fund that owned Amtech paper. Two of its schemes had invested a total 193 crore rupees in Amtech debentures. The investments amounted to 15% of one scheme and 5% of the other. A month later, in September 2015, Amtech Auto defaulted on the interest payment on its debentures. Net asset values of the two JP Morgan schemes fell, and investors rushed to redeem their units. JP Morgan responded to the panic run by imposing a redemption restriction. Investors were allowed to redeem only up to 1% of the scheme's units on any given day. The fund's move drew severe criticism and regulatory intervention. After consultation with market regulator SEBI, JP Morgan asked unit holders for approval to segregate the Amtech investments from the schemes. And eventually, it sold the Amtech paper for reportedly a quarter of its value. The 2 months of high drama forced a sharp fall in the scheme's values and raised several issues for India's mutual fund sector.
I think there were several of them. One was large investment in large exposure to one single entity, very large investment in Amtech Auto. That was one risk that came up. The second risk was that when the company got downgraded, the bond prices in the market, there wasn't really enough trading to disclose a proper price for the bond, and therefore the NAVs were not representing the price at which you could sell, and therefore redemptions became a problem. If somebody redeemed the bond, they redeemed at NAV, but the NAV was not the price at which the assets could actually be sold, and therefore investors who stayed back in the fund lost out to those who redeemed.
62% of India's $190 billion mutual fund investments are in debt schemes. That's 7.88 lakh crore rupees of a total 12.74 lakh crore of assets under management. Insiders say only a fraction of that is invested in high-yield paper such as Amtech debentures.
If you actually see the credit rating profile for these schemes, a predominant chunk of this is actually in the AAA and equivalent assets. The only place where there is non-AAA exposure or the category would be at the mutual fund industry level could be about a lakh and a half crore, which is the high yield or the accrual category funds.
But that approximately 15% exposure was enough to prompt market regulator SEBI to put in place new safeguards. So far, a mutual fund scheme could invest a maximum 25% of its money in the debt of a single issuer. The limit applied on debt categories. For instance, the fund could invest up to 25% in money market instruments of an issuer and another 25% in debentures of the same issuer. Last week, the regulator reduced that limit to 12% and also capped the combined exposure to money market and non-money market instruments of a single issuer at 12%. The additional exposure limits for debt instruments of housing finance companies has been reduced from 10% to 5%. And SEBI has also introduced a new 25% limit on a scheme's exposure to a business group. The new prudential guidelines have drawn mixed responses.
it cannot be a one size fits all. So you cannot have a 10 plus 2, which is a 10% per issuer limit, can go up to additional 2%, that's 12% with the trustee approval. It may not be appropriate to have it across the credit rating curve. There is a perception, implied expectation of a AAA credit performance over a non-AAA, and as you go down the curve, the implied risk only increases. So that is where probably some more measures may need to evolve.
There is a catch there, and to realize the catch, one only needs to go back to the subprime crisis of 2008. Where did the losses come? They all came in AAA rated paper. Okay? So the issue in credit is that the problem is in fact greater in instruments which you think are safe and turn out not to be safe. In fact, when you buy low rated paper, at least what is happening is that you're getting a higher coupon, and even if there is some distress, you can at least say that, okay, for 3 years I earned a higher interest rate, which compensates me for some of the losses that are happening. In AAA, what really happens is that you are getting very, very low interest rate, and if that gets downgraded, then you are eating the credit loss as well.
However good they are, these new safeguards may not prevent all future crises. Yet, SEBI has not issued any guidelines on what to do if that happens. The JP Morgan episode was the first time that a mutual fund has used redemption limits or gating and segregation or side pockets. But the regulator is silent on whether these can be templates for future crises.
Gating to some extent sends out, I would say, a lack of confidence in the investor fraternity at large. It does not impact, you're right, as you rightly mentioned, the fund house. But in certain cases, the gating is necessitated with the nature, given the nature of the underlying corporate bond market, which, as I just mentioned to you, is quite illiquid in India. May not be, I would say, the most appropriate solution. A better solution in a credit kind of a scenario probably would be a quarantining kind of a thing, where you create a separate NAV out of it till such time that there is a solution created.
The other area that needs immediate attention is the regulation of credit rating agencies. The sudden suspension of Amtech's rating by CARE and a drop to default rating by Brickwork drew criticism even from peers.
I think the biggest risk from a market and a regulatory perspective was obviously the jump to default, the fact that the ratings moved down several categories. That clearly is not acceptable by any standards. It's actually possibly a disservice that any rating agency could do to the markets.
After the JP Morgan fiasco, SEBI met with ratings agencies to warn them about industry practices such as sudden rating changes, suspension of ratings, and ratings shopping.
When we evaluate the performance of a rating agency, we measure not only that you had a AAA rating and how many of those AAAs defaulted. Probably none did. It's very rare for a AAA company to actually default. But we also ask how many of them got downgraded. And you would also say that AAA getting downgraded to AA is fine. If you're talking about 5-10 years, then getting downgraded to A is also fine. But if it gets downgraded beyond that, or it gets, like you're saying, you get a 6-notch downgrade very quickly, yes, that is also will count as a failure.
More scrutiny and new regulations may help curb such ratings practices. On the other hand, rating shopping may be an outcome of too much regulation. Fund managers are not allowed to invest in instruments rated below AA. For many issuers, that cuts out an important source of funding, and so they go shopping for that AA.
All that money out there essentially follows AAA and AA, so to some extent it distorts pricing there. But beyond AA, so for example, if an issuer is rated AA and gets downgraded to say AA minus or A plus, which by any standard is a very reasonable circumstance which could happen because of various reasons. But the moment that happens, that paper becomes immediately illiquid, and that's because of regulations. I think the time has come to give fund managers greater leeway. And to have a system where fund managers investors can openly talk about their risk appetite.
SEBI may need to do much more to safeguard against a repeat of the JP Morgan Amtech episode, as do fund managers, because when such a crisis occurs or is about to occur, alert institutional investors are often the first to redeem. They exit at NAVs that may not have fully adjusted to the reduced asset value, and retail investors are often left carrying the can. Should funds be asked to compensate investors who stayed behind during a credit risk event? Or should that fall upon the credit ratings agency?
If you knew that a bond was illiquid and that its valuation was suspect, and you allowed large investors to redeem from there, then you would be liable to make up the loss. So it is up to you to figure out and to demonstrate that on the day that you allowed the redemption, you did not have material reason to suspect the carrying value of the asset. That obligation should be put on them, and that material information can come from many sources. If the stock market has, if the stock price has dropped 35%, then I would think that there is material reason for the fund to start thinking about whether the credit risk has been impacted. You can't just say rating agencies said nothing.
SEBI's new prudential guidelines may only be the start of more action to prevent another JP Morgan Amtech episode. There's also a view emerging that, like credit ratings, should mutual fund schemes also be rated to communicate the degree of risk associated with them. It's not clear how much that would help. The best is that investors remember that mutual fund investments are subject to market risk, read all scheme related documents carefully, and now we know that applies to debt and equity investments. In Mumbai with Menka Doshi, Sajeet Manghat.
That's all the time we have on this edition of The Firm. Thanks very much for watching. We'll see you again next week.